Justin McCarthy is a lawyer and trader who manages hedge fund in Europe, and he's always had some great insight, and he's been willing to give back and help teach other people how to trade. Uh, One of the smartest minds that you'll find on social media and anywhere, actually. So join me once again as we welcome back Justin McCarthy. If you enjoy this content, please click the Patreon link and give us $1 to help support the show. Thank you so much, and on to the interview.
Huh. Anyway, I love the that you pulled out the old trading jacket and tags for your show. That's fantastic, man. It's good.
It's supposed to help me establish credibility if I can do that.
With the red velour,
Right?
magic.
Exactly. So what's been going on?
Oh, just on doing, as you know, I have a legal activity as well as trading, and that's been kind of busy lately. So that's good. Trading is that was pretty intense during that spike, of course, because I started throwing, leading really into that big vol spike. So that's paying off now. I mean, I'm not in huge profits yet. I'm in small profits now, but at least we overcame the big drawdown that lasted about it was in drawdown for what a bit over a week,
So
but
how?
that's to be expected.
So did you come into that short some volatility, or were you long volatility, or
No,
you
I
were
was not long. I didn't take the long side at all. At all. It's just I'm just not into it, you know. I'm just. I mean, I know some guys can make money on the long side of volatility too, but maybe I'm not as quick and nimble as them, and I just prefer to stick with the higher probabilities, you know.
was it a shock to you that Monday? What were your emotions going into the?
Well, I wasn't really shocked because, well, it's always a surprise because it's not as if I could foresee this coming or anything. Although everybody knew that it would happen sooner or later one day, but nobody ever knows which day. You always get somebody saying it's going to happen tomorrow. It's going to happen tomorrow. But it's just one of those things that I was expecting, and it was a big relief actually because it permitted me to reestablish some fresh, nice big positions for 2018. You know, on the downside, I was a little bit bummed out that I cut off my trend following ES position, as I mentioned to you. You know, did I mention that to you?
No, I don't think you did.
Okay, yeah, I was like trend following ES for quite some time since late 2017, and making decent money on there. As you know, I trade the Nikkei quite a bit as well, and I just thought, okay, the volatility is dead. They're just kind of wobbling around now. I'm going to allocate money elsewhere, and then they dropped off a cliff, and unfortunately, I wasn't in the trade anymore. So I kind of kicked myself for that. But opportunity, you never know where the next opportunity is.
Well, I'm glad to hear that you didn't get hurt really badly because there was a theme across the
No, man, I
board.
didn't get hurt. Yeah,
That's
I
good.
didn't get hurt. I just took a drawdown, but that's just a normal procedure when you're establishing short vol. You gotta take the heat, as I've said it often, you know?
Well, I came really close to getting run over by a freight train because I was naked short a bunch of calls in UVXY, and I Monday morning I've been thinking about it all weekend, and I kind of just panicked Monday morning and took them off. And I don't usually panic, but in that situation it really saved me because it would have been a bigger drawdown for me. I had too much exposure really, so
Yeah.
I'm happy I took it off. But I heard some horror stories from people that probably had allocated too much of their capital to one investment and really paid for it.
Yeah, yeah, yeah. I was just the call I was on just before we called here. I was with one of the chaps we know on Stocktwits, he has a sizable, really sizable portfolio, quite sizable, and he got a big kick in the balls from that spike because he had a long position, kind of like a just buy and hold position in XIV. And so that kicked him in the teeth big time, like so many guys we've seen. And it's a shame because this guy, he's a really bright guy. Yeah, he's been, trading for nearly 20 years apparently. And he should have been like, he should have, it's not a reprimand, it's just an observation, should have been, with his experience and size, should have been in dealing in professional instruments instead of screwing around with these retail instruments. Just would have been more efficient. But I'm talking to him about structuring some things himself now, and he's into it. So he's pulling himself together. He's pulling himself off the floor. He didn't lose everything, but a good chunk, and he'll give it back.
Well, I have a friend who it's interesting now for me actually doing this social media stuff and being online and interviewing people. Um, I've met all these new people, and you talk to people, and sometimes you don't realize that they're way bigger traders than you are actually
Hmm.
by you I mean me. And I
Well,
saw
there's always bigger than you.
there's
There's
always
always more intelligent. There's always more handsome. There's always more rich. So,
of course,
always.
but it really took the wind out of my sails to hear some of the losses these guys had, and I felt bad for them. You know,
Well, it's a chap I was speaking to is, 500,000, and that's not a firm. It's an individual.
that was a similar story that I heard from somebody, and I, I think back and I want to give people the full picture when we talk about this stuff because we focus sometimes on just an individual product without saying, look, our overall our overall money in life is not in that one product or in that one trading account. It's
Yeah.
in different spots. I fear some people fall in love with one particular piece of the market or one particular stock or instrument and allocate everything to that. And we
Hmm.
don't talk enough for people, I think, about how that's not what we do.
Diversity. You have to have a minimum of amount of diversity. Even if you're trading just a volatility portfolio, within the volatility portfolio, it's just reasonable and more economically viable to have diversified volatility within that vol portfolio, you know?
I mean, and also like for example, like I have my trading account where I mess around with stuff, but then I have long-term savings, which some of it is in sort of buy and hold strategies, some of it is in cash equivalents,
Mhm.
and it stays in this sort of conservative stuff, which is not as much at risk because you have your money that you need for things like rent and things like retirement that you want to keep separate from the higher risks type things.
Mhm.
I know we talked recently, and it didn't actually come out to the public, but you mentioned just that about XIV and these products. These I think you called them sort of prepackaged vol products, and
Yeah, which they are, yeah.
how the public doesn't really understand the risks of them. And I think they're becoming more aware. I saw actually the cover of the Wall Street Journal 2 days ago on the right column said VIX products being investigated. So this is in the public eye right now in a big way
I
in the
know
U.S.
yeah, we're living in historical times in in our niche market, yeah.
And I guess I wanted to ask you from our past conversation to discuss a little bit because I found it fascinating how you adjust risk over a portfolio of assets to balance out ones that are less volatile and less notional value with ones that are more volatile, so that you were explaining to me that there's no point in having diversity in a portfolio if one part of it has such a small effect on their P&L that it's negligible.
That's right.
Um,
Yeah. So it's a pretty simple mechanism, which is largely used amongst hedge funds. There's no secret about it. It's called now it escapes me. The technical term is oh, it'll come back to me. It's something I work on every day, and it's basically just if you just okay the traditional stupidity that I've seen in the fund world when I was working in funds many years ago was asset managers saying, okay, I'm going to diversify my portfolio. And first of all, they're starting off with like a bond and equity portfolio. Well, okay, they kind of move together, so it's not really great diversification. They're, as it is. And then they go and spend, like 2.5% on this stock, 2.5% on another. And in there, they'd have these, boring utility stocks with an allocation of X, and then they'd have the same allocation for a new upcoming pharmaceutical company, you know? So like this new pharmaceutical company might, jump around 10% a day, and the utility stock is jumping around a quarter of a percent a day or something like that. And so it's the impacts are just unbalanced. So that's a bad diversification. In fact, good diversification would be okay, if you want to have something that's really slow and not volatile, well, you have to allocate more cash into it so that its volatility will impact your portfolio's volatility at approximately the same rate as all the other shit you have in your portfolio, right? So, uh, capital wise, you put more money into things that are not volatile, less money into things that are more volatile. Duh, you know,
yeah, exactly.
just makes it just makes sense.
One of
And okay, it's a volatility adjusted um, weighting, volatility adjusted weighting in the portfolio, if you like. I can pull up a document on it anytime if you like. But it's just what pretty well every hedge fund on the planet does, and it's just been a long standing. In fact, in matters of trend following, if you speak to any of the guys at hedge funds that have been around a long time, like Winton and that really famous crowd, they actually say that the weighting, the volatility weighting, is the most important thing in the portfolio. And it barely matters whether you go short or long using a MACD, a Donchian channel, or whatever. Your exits and entry signals are, over time insignificant because you're going to be wrong most of the time anyway. So what they say is what really is the most crucial thing in the portfolio is a bit of diversification, a fair bit of diversification, but with volatility adjusted diversification. Otherwise, you'll have one position there that has no impact on your portfolio, whilst you may be having 5% of your portfolio dominating the rest of it.
So to give real world examples, you were telling me last time, for example, about some of the grains that you trade. That you
Mm.
have positions in that are lower volatility compared with I don't know like
Yeah, like nat
selling
gas, like
calls
that.
on the Nikkei or something.
Oh yeah, please, please, thanks. Yeah, exactly. Like nat gas moves like hell, and as you may have seen, corn is kind of not doing much lately. So of course, it just makes sense to allocate more resources to grains, and not because I'm more bullish or more bearish or I'm more hopeful or anything, just because if I want them to impact my portfolio, I have to put in a bit more money to make them impact my portfolio, and a bit less money in that gas, to get the same results, basically.
So then um, if one thing all of a sudden gets really volatile, like if corn or something gets really volatile,
Well, yeah, you have to make adjustments from
you
time to
make the
time,
adjustment.
but I don't do it on a daily basis because that's just too crazy. look at it more like depending on the cycles that you're dealing with. For example, if I'm dealing in options, well, I'm going to look at the reference would be the 20-day average true range of the underlying. For example, it's 20 days, it's 20 business days, meaning 1 month. A 1 month average true range is a good measure of average volatility lately, which corresponds to, you know, a good cycle of an options trading position, right?
Yeah, I think it's a good yardstick also just to think about in your mind as you watch stuff trade on the tape, like because
Yeah,
it's something that you can actually kind of conceptualize easily in your head as opposed to some of these other indicators. I think.
yeah. Well, the yeah, the average true range as a volatility trader, when you look at the underlying, that's where you have to start. Is what is its realized historical volatility, and then we can start dealing with the derivatives and everything. Because if you don't pay attention first to the underlying, well, that's the measure of where the implied volatility should be approximately, right?
Yeah, exactly.
Yeah.
Um, there's this guy that's been a lot in the news lately. His name's Chris Cole with Artemis Capital, and
Yeah.
he put up this pyramid, and it shows at the top of the pyramid are like these exchange traded funds like XIV, these uh, very sort of blatantly volatility products. But then he talks about how structurally in our system there's short vol trade on, and what he talks about is fund managers who have a volatility adjusted portfolio when short vol starts to happen, they have to kind of readjust because their maybe their short vol exposure is too big, and so they need to sell out of the short vol and buy into other investments, and that when
Absolutely.
and how that the need for all these guys to do this sometimes it's laid out as sort of a formula, and all these guys readjusting as well as guys who like when the ES goes way down they need to sell futures against their gamma or something. These sort of adjustments can be more significant as far as a market effect than just the guys who are in public who are long XIV and those products. And he was discussing how it can be sort of a perfect storm of events that hits the market when we
For
get a
sure.
big move.
Yeah, because don't forget the hedge funds, for example, they're all doing essentially the same thing, you know? Well, there are categories, but there's basically what do you have in hedge funds? You have long short, you have trend following, you have volatility, and then you have some fundamental shit like merger acquisition, but those guys don't even really count as much. But the especially the long short guys and the trend following guys and the vol guys in the hedge funds, they all have the same menu. There's not a lot of diversification from one fund to another. In fact, because they're all going to be trend following, grains, energies, equities, bonds, maybe with slightly different time frames, but that's about the only difference, maybe with some different leverage or whatever, but because they're all on the same side at the same time, and they're flipping their positions, not just stopping up, but stopping and reversing their positions all approximately at the same time. Yeah, that definitely exacerbates a lot of moves, of course. Yeah,
Um, have you seen volatility sort of come in across the board lately, or
definitely. Yeah.
has it come in some specific spots more than others?
I have a whole screen here dedicated to it. Here, I'll show you my vol. I don't know if you can see it from there.
Oh,
You
cool.
see all these little charts?
Yeah.
Yeah, all those little charts. Those are, all charts of volatility up on the upper two screens there.
Wow.
There's just like dozens and dozens of little charts, and they're not price charts; they're volatility charts. So I'm tracking, indices, meats, metals, energies, everything. And what's kind of bothersome, in fact, as a portfolio manager, is that, yeah, volatility came in everywhere at the same time.
Hmm.
So the problem with that is lack of diversification. So despite my best efforts to be diversified, there's not really much diversification in my portfolio anyway, because everything spikes at the same time, everything comes down at the same time. Whereas the traditional idea behind diversification is some things are going to be flat while others go crazy, but everything is flat and crazy together at the same time these days. Probably because our business has become so big, and we dominate the market. It's just an effect of everybody doing the same thing and trying to diversify, therefore hitting every asset class at the same time.
Well, it's the advent of ETPs, and
Also,
it's
yeah.
the same thing in the equity market where like once stuff starts moving a lot, it becomes a stock market as opposed to a market of stocks. Like everything's down the same percentage
Hmm.
exactly, and you notice the major indices move in lockstep together when we have these big
Hmm.
moves. And you're right. It's how do you get some diversification in that setup? It's hard.
It's very difficult these days, and all I've seen, like all of the major hedge funds out there, they're all, I wouldn't say complaining, but observing the same thing. Like trying to find real diversification is extremely difficult in these modern times.
I
I mean,
found it.
even
Sorry, go ahead.
yeah, even if you go to different countries, jurisdictions, Asia, Europe, America, they used to be maybe similar but quite different. Now they all just move together.
Wow. So it's
You know?
worldwide that sort of
And
trend.
yeah, it's not even asset class wide; it's globally asset class wide as well. So whether you're looking at look at crude oil and equities, for example, it's not the same, but pretty well the same chart.
Now, is that a bad foreboding sign for the future moving forward?
I don't know. I'm not an economist, but as a risk manager and portfolio manager, it's bothersome because if I go into equities and crude oil, well, it's almost the same trade.
All right, I have a question for you, which kind of comes out of our Stocktwits buddies in the last couple hours. It's been very, very common. People who are trading the short vol have been saying the last day or two, why is vol not coming in? Why is market's been up and volatility has sort of the VIX has sort of stayed sideways, and I know what my answer to that is, but can you respond to that? What people are saying?
So the comment is precisely what
Why
the
isn't
vol.
why isn't vol come in more with the indices up the last day or two?
Yeah, that's a common misconception. A lot of the time, implied volatility will move, in the opposite direction of its underlying, well, in equities anyway, for sure. So you get equity indices that move down, and of course you have natural hedgers out there who have long positions in the equities, so they're going to be starting to buy puts when they see the market going down a bit, and that's what happens most of the time, and that's probably the biggest impact most of the time in matters of volatility. So when equity indexes drop, you see implied volatility going up. However, implied volatility takes into consideration both sides of the skew, not just the put side, right? So, um, I mean, implied volatility can jump up significantly even when an equity market moves up, if it moves up really, in a fast manner, right? So people must understand that even though it looks like they're doing opposite things, and that's kind of the normal relationship between implied vol and the equity index, that's not the mathematical relationship between them. You know, implied volatility will jump when whenever people are buying options like crazy, and they could be buying back covered calls, they could be putting on covered calls, but and then on the put side they could be buying puts or unloading puts when they see them shrinking to zero and their fear is subsiding. you know so what's happening now, what I see is basically the story is for the past 3 days, Volatility has gone sideways in equities, whether it be in Europe or United States or in Asia, whilst the indices have been rising. But so some people are thinking, well, the implied volatility should be dropping, right? Well, not necessarily, because people are still nervous. I mean, we only had this big shock last week or whatever, and there are still a lot of guys that are nervous about a drop, so they're still buying options. I'm talking about the natural hedgers, still buying options to protect their positions, thus keeping implied volatility elevated, regardless of the stock market going up or down,
Well,
right?
the other thing is that we did, if you look at the last week's chart of like a UVXY or the VIX, volatility has come in huge. Okay, it came,
It's
yeah,
dropped
right.
significantly already.
It was down like 5 points 3 sessions ago, and it hasn't retraced back up at all. So if you take, I mean, UVXY was trading then it was trading up in the 30s, and now it's trading 16. So volatility has come in huge, and I think these people, you can't expect it to come in every day.
No,
That
I mean, like,
it's
yeah,
like the air is coming out of the balloon slowly, but if you look at the VIX chart, it's
but
come
it's
in
not even that
significantly.
slowly. I mean,
Right.
we've cut the volatility in half. Like here, I have what do I have in front of me? I have a V stocks. I don't know if you see that chart up there.
Yeah.
It's a V stocks. You know, we're down here. We've lost we've come down more than halfway from that spike.
Yeah. Exactly.
And that's a massive drop. The high was 23. We're at 1790 now.
Now, do you think a lot of people are saying, okay, there's volatility when we last talked was in the nines, tens in the VIX. Uh, is there a chance that we could get back to anywhere near there? I mean, I heard yesterday, I think, that major indices are actually back up on the year, in the positive territory on the year now, or close to it. They're down a little bit right now. But do you see volatility going back to the lows it was at last summer?
Uh,
Obviously, you're not a magician and can't predict the future.
yeah, like it's possible. Yeah, that's my best answer. Is everything's possible, and I'm prepared for it.
Yeah.
You know, I mean, I think I'm a quantitative trader, as you know. I don't try to predict, or I don't read reports from CEOs or anything. I just look at numbers and what's mathematically observable. So can it happen? Absolutely. Will it happen? I don't know, but I have a plan for each case, and I just adapt to every scenario, you know. And sometimes the guys who guesstimate things probably make a hell of a lot more money than I do. It's entirely possible. But I just, you know, I've been around the market for quite some time, and I've never been able to forecast anything, and I've never seen anybody accurately forecast anything repeatedly for any given period of time. And not to say I'm so credible and everything, but I was overseeing the equity research desk at HSBC in France as a compliance officer, and I had to go through these analysts' reports every day. And so I was really abreast with equity analysts back then. And my conclusion was, well, half of them are mediocre at best half the time.
Yeah, I mean, they get it pretty bad. Is my microphone too loud still, or is it
No, no,
okay?
it's good. It's good, Dave.
They get a bad rap, and they sort of kind of revitalized the industry a little bit a few years ago from because that initially it seemed like in the 80s they were all bought and paid for by like whatever stocks they were representing, and they were just really awful. Like they never gave sell recommendations and stuff. They've come a little ways, but they still get a pretty bad rap as far as
I still, from my experience in the profession, in investment banking, it's just sincerely, it's a marketing thing for the investment bank.
yeah, they kind of describe the past really at best. Like they'll make a
Yeah,
recommendation when something's already up 100% or
I
50%.
know, like, yeah, the thing's in a raging bull market for a year. It's now trading at 75, and then they have a target at 75, 75 or 78. It's like, yeah, well,
I was I was dating a woman in college, and I'm 100% sure she's not going to see this, but I'm not going to give her name anyways. But uh, I got out of college, and I started working as an auto mechanic, and she didn't like that at all, and ended up leaving me and stuff. And fast forward 5 years, and I was a market maker, and the exchange had paid for me to fly to New York. They gave me a plane ticket to New York to go to something at NBC Towers, and I was sort of on the top of the world, and kind of called her to kind of gloat. And
yeah.
she told me she had gotten a job as an analyst for one of these research firms. And this was like in the mid 90s, when like we just thought analysts were like just the biggest scumbags ever, because they were just basically touting whatever. We figured that when they recommended something, it meant that their firm needed to get out of it, and they were trying to like put the buy in so that they could get out ahead of some bad news. And so,
But that's often the case.
yeah, yeah. So when I heard she had gotten that job, I was sort of vindicated that it was over between us.
Good for you, Dave.
I don't know, it's sort of funny.
So I recall that you wanted to review one of the strategies that I have on options, short vol, like constructing short volatility positions from scratch with the various phases that I explained to you.
Yeah, that's fascinating. Let's talk
It
about
is,
that.
and it's so goddamn simple, It's really simple. I mean, simple is a relative term in the options market, I suppose, but if anybody knows at least a fair deal about options, they could look into this and repeat it themselves. But from the onset, I want to explain one thing. It's crucial to understand that in trading, regardless of the style of trading you're doing, whether it be trend following or whatever, as long as it's not completely arbitrary, if you have an actual model according to which you trade upon, it has to be repeated day in, day out, or at least week in, week out, or whatever your adjustment period or trading time frame, because the repetition is the thing that makes it take over. It's not a single trade. A single trade is meaningless in the life of a portfolio. And so when you go into putting together a quant model, which it is actually, the repetition is crucial, because if you don't get that repetition, you're not going to be hitting the statistics that should be showing up in your portfolio. Let me give you an example. We know that deltas on an option are a rough approximation of the probability of the option terminating in the money, right?
Yes.
So you say, let's put on a 20 delta strangle. Statistics tell us that there is a 20% possibility of one of the options going into the money. Otherwise said, an 80% probability of the options not going into the money is what we want as short options traders, right? But you put on one trade, and let's say you put on two trades, okay? First trade, everything works out, and your strikes are not hit. Second trade, one of your strikes gets hit. Well, in your portfolio, that says 50% of the time it gets hit, right?
Right.
Whereas in the theoretical world, it says that should only happen 20% of the time. If you do that thing 100 times over, you're going to get closer to that 20-80 ratio. Okay, if you do it 1,000 times, you're probably going to be within a percentage point of that ratio. So the repetition is crucial, and that's what a big thing that a lot of guys make mistakes on. They say, "Oh, I got this new model; it makes sense. I reviewed it; it's great." They put it on, they make some money, and then they'll go into a losing streak, which happens for every trading model. And they'll think, "Oh my God, this is not working," but they're not giving it enough sample size to actually live up to its expectations.
Yeah, it's like
So
as occurrences goes to infinity, expected return, or then your actual goes to expected return. It's like,
Precisely. It's
yeah,
called the law of large numbers.
yeah, yeah.
Yeah, and that's precisely what I wanted to make people understand before I introduced this very simple technique, which is not, it's not my clever, brilliant idea. It's just what I've learned throughout the years from other sources, and I'm just doing what works. There are principles which work, principles which don't work, and this one just works. That's why a lot of options traders or vol traders use it. And what it consists in is simply putting on a short volatility trade via commencing with a strangle, okay, and then managing it throughout the life. But it has to be repeated so that we hit those expected statistics. So, do you want me to go through the process a little bit from A to Z? Yep. Okay. So what I do is I start on my screen here with all of my little volatility charts. So I can see, like, dozens of different assets in terms of implied volatility, right? And I can see right now, for example, the British pound is at its highest level of implied volatility over 1 year and rising a little bit. So we're at 10% of implied vol on the on cable, and so there's my first thing I look at. Okay, so I'm going to go into I'm going to start shorting volatility on the British pound soon. Then I'll go into looking at the options and the volatility skews, and I'll look what the skew looks like and the vol surface to determine which expiries, which cycle I want to start dealing on, right? Because as you know, and it's going to be a little bit technical, but it's just part of the process. Looking at the volatility surface, after locating the highest implied volatility on a given asset, then we go and examine, okay, which skew or which expiry and which strikes are we going to deal with? To determine that, we start by looking at the entire volatility surface, anywhere from like 30 to 100 days out. And then we'll locate the skew or the expiry that looks most tempting because of its configuration, because maybe the smile is really deep, or because maybe there's some dip, weird dip in the vol skew where you get some super cheap protection or some ultra rich option somewhere in the skew. And then that's how it starts. So now we have a selection of which options to deal with. And I generally start off, well, it's systematically, I start off with a strangle, okay? And it will be as wide or as tight as the volatility skew determines. Because I'm not just going to say, okay, every time I just put on a 20 delta wide strangle. That's not how it works. I look at the skew and it will tell me where the richest and the most expensive options are, and then I'll construct my strangle according to that, so that I'm getting the most when I'm selling and paying the least when I'm buying, right? And sometimes that difference on a single trade won't be hugely significant, but it could change the whole trade by 2 to 4% in the end. But if you do that 1,000 times, that adds up, you know?
So in general, at the money options are a lower volatility than the out of the money puts and calls. Is that it?
Well, generally they are, because generally you have a volatility skew, which is it kind of sags in the middle, then it goes up like a smile, and that's why it's often called the volatility smile as well, meaning that, yeah, effectively the out of the money options are generally more expensive. Now that becomes a little bit meaningless if you go too far out, because yeah, you'll have an option that has, like, say the at the money front month volatility is at 10%. You can go out this, you could probably climb all the way up to 25% implied volatility, but for options which are trading at a penny. right?
Yeah, and you don't want to
So
be selling that stuff because you're just
there's no
shorting
point.
units and there's no meat on the bone. Yeah.
Exactly, exactly. So you have to find the nice. There's a relationship, and we can calculate this relationship by examining implied volatility compared to how many deltas are in the option. Okay, and then when you look at that relationship on a spreadsheet, you can start seeing where that relationship is the meatiest, like the most implied volatility. What you want is you want more, you want the highest volatility for the most deltas, and that's why you don't go way the hell out to the end of the skew to get maximum volatility but zero deltas,
You
right?
want bang for your buck, so to speak.
Yeah, you want back free, but that's all it comes down to. Yeah, precisely. Now the process then is pretty simple. After determining which options to use to implement your short strangle, and when I do that, it's a naked short strangle, so I don't buy protection right away. Why? Because first of all, I'm starting with a strangle that's relatively wide, and so there's no immediate danger there. Even if it does move, I can do things. And then just say, for example, we start with 20 delta wide strangle. So we have 20 deltas on the call, 20 deltas on the put. We're short both options, so we're short the strangle. And then when we put on the trade, we're approximately delta neutral, right? Now the underlying is going to move up or down and for a while. And if it moves a bit far up or down, your deltas are going to get offset. One of your options is going to become, for example, 40%, the other 15 or whatever. So what I do is when those deltas go out of whack by depending on a few variants, but generally speaking, between 15 and 20 deltas off, then I readjust by simply bringing in the profitable leg. So don't worry about the leg that's being hammered. Take the leg that's making money, then roll it in so you get a tighter strangle, and you reset your deltas near zero again. So what you're doing effectively by doing so is one, you're taking profits, which is always nice. Two, you're reducing risk by recentering your deltas to near neutral. That's good. And you're capturing more premium. Okay? Now, ah, okay. Okay, thanks for the coffee. Um, so there's just immediately three benefits from tightening the strangle and recentering your deltas. Okay? Then, say several days or a week later, it's going to move again. And you now, with time and with a tighter strangle, you're going to have more gamma in the structure, right? And more, more gamma. And therefore, it's going to start reacting quicker because your options are now closer to the money. So it's a bit more of a violent beast. When you start off with, and if I'm showing this one of the chaps, we know together how to do this, and I'm sure the guy's just bored stiff thinking, God damn it, this thing doesn't move, because he just put on his first one, which is 50 days, or I don't know, it's over a month out, quite wide, and it's not reacting much. But he'll see that when he starts tightening it, it's going to start reacting more, and then we're going to add to it, and I'll get there in a second. So when you start tightening this strangle, it's going to be, you're going to have to monitor it more and more frequently because it's more gamma sensitive, meaning that you're going to have more or less deltas being manufactured with smaller moves on the underlying. And then if we get to a point on that trade by itself that we can cash out of it for like about say 50%, 40 to 50% of maximum profits, take the trade off, put on a new strangle that's wide, start over. That's step one of the process, okay? The other hypothesis is that it jumps around and it jumps around faster than theta is working, for example, and we're not profitable yet, but we get to tighten this strangle until it becomes a straddle, okay? And that's where your max max potential profit is, but it's also where the lower probabilities are. At that point, when we tighten our strangle so much that now it becomes a straddle, that's when we need protection. Now, that generally won't happen for at least a week or two, or possibly three, or maybe a month after we initiate the trade. What do you think is going to happen to the price of those out of the money options during that time that we need to buy for protection?
It's going to get a lot cheaper.
A lot cheaper,
Yeah.
a hell of a lot cheaper. That's why it's a bit naive to put on protection immediately when you put on a short strangle. Because if you buy the protection right away, you're shooting yourself in the foot.
Because you can
You see?
call, I guess they call it, if you do have that straddle on and you wait and finally buy those what quote unquote wings in, then you get a butterfly on. You're long the
Well, that's it.
yeah,
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 yeah, yeah, yeah. So, but the beauty of that approach is that you're taking, with a large strangle, you have really minimal risk. As you're tightening it, you're increasing your risk. And then at the point where you roll it into a straddle, that's where you have maximum profit potential and maximum risk. And that's when you must buy the protection. But if you start with a wide strangle and go into a straddle, that may take a week or three or a month, depending on many things. But the key here is that the protection is only put on once you actually legitimately need it, and when it's a hell of a lot cheaper, because you're not going to tighten a strangle into a straddle within a day. It's going to take at least a week, or in a fast market, uh, or a few weeks in a normal market, and then that protection becomes so cheap,
I
right?
mean, yeah. The other process that you were describing to me was just let's assume an underlying is not moving around very much, but it's in a very, very low end of the volatility range. So
Hmm.
starting with the strangle way, way wide out when we're in low
Yeah, and
volatility.
and this is an interesting point that you bring up, Dave, because a lot of guys will look at the market and say, "Oh my God, the vol is so low. I have to write closer to the money to make any money." By doing that, what you're doing is you're setting yourself up to get kicked in the head, because if you write too close to the money and the vol jumps, you're going to get whacked right away, and you're not going to be able to recover that trade for any profit. You'll have little hope, little hope. So you start wider and work in, and if vol is low, you start even wider, maybe further out, so you get something decent on the bone. But you just have to be patient, and we can only deal with what the market gives us. By the way, I just had an execution somewhere, I
Yep,
think.
yep.
Uh, oh yeah, just sold more V2TX grand.
Well, we're seeing now in UVXY in the VIX setup, we're seeing VIX down with futures down now. So, well, futures kind of mixed, I guess.
Hmm. Oh, I have
Well,
a decent Friday so far. So I have a what I call the big short in my portfolio, which is, kind of makes me a little bit scared. But if you don't have that fear, that means you're not doing something right. So I'm
well,
quite heavy short equity vol on the Euro Stocks 50. Yeah.
well, I love the idea of that little strangle, even in low volatility, especially for new traders. If you put on a trade that it's a high probability trade of success, maybe 90% success, it's not giving you that much money. That's a great trade for a new trader to put on, because what it does is you're in the market now. You have something on, and it helps you to
And
focus. It helps you be engaged with the
exactly.
marketplace. And maybe you're risking $100 to make 20 in terms, but you're in the market. You have a great chance of actually having a winning trade, and you're engaged. And so that's a great way to get involved. I would
And it's
say.
not just a buy and hold. It's not like you slap it on and then just wait till expiry or whatever. You manage it, so it's actually um, intellectually interesting. You know. So you understand the process of what I do with these large strangles, and then roll them in either until they're nice and profitable. Then I just take them off and put on a new large strangle, or I continue to roll them in until they become a straddle, and then buy that cheap protection the because of the out of the money options will have decayed so much by the time I put on that straddle. Now, then the second part is very interesting too, or the third part, if you like. Once I'm in that straddle with protection, what I do immediately, I go in and put on another large strangle. And by the way, if I'm in a trade which makes me roll in to a strangle, what does that tell you? That means the market moved a hell of a lot very quickly. What happens to implied volatility in that case? It'll generally be higher. Therefore, when I put on that fresh large strangle, I'm going to be selling vol at a higher level.
Better prices.
Exactly. So when vol is low and not climbing, I'm profitable pretty quickly. When vol gets higher and I have to roll in and take some heat, in fact, then I'm just leaning into it more and more and more and selling more. But the actual risk profile, is almost identical. It's not that much bigger.
Well, let's say, for example, that I do this and I put on a strangle. I sell a strangle that's maybe, I don't know, $20 wide,
Yeah.
and things go against me. One side, it goes all the way through the strike by like $10, and
hmm
now the strangle is like way lower. Both sides of the strangle are way lower than the underlying. What do I do in that situation where I've lost?
Well, first of all, if you put on a wide strangle, I can't see how it would pierce like it would go touch one of your strikes on a dime. It's not going to happen in a day. You know, I mean, no commodity or index, well, except the flash crash and stuff like that. But then just nothing to do because there's no quotes anywhere anyway. But even under stressful and fast-moving market conditions, you're gonna have ample time to roll in your leg and reduce your deltas back down to neutral. It's not realistic to think that you're gonna get a one standard deviation wide strangle, just put it on, and then 20 minutes later it's gonna start attacking one of your strikes. That's not realistic. And if it does happen, there's nothing you can do about it because there won't be any quotes on the options market anyway.
Well, what about
You
if
know?
I've gotten to the I've gone through the process and I've gotten to the place where I am short a straddle? How do I if stuff starts moving one direction or another? How do I
You don't do anything with it because at that point, as I said, when you roll it in, so when you roll your strangle in so tight that it becomes a straddle, at that point in time, that same moment, you put on that cheap protection. And when you do that, it becomes a defined risk trade, right? And in matters of defined risk trade, you just let them play out to the end and see what happens.
so essentially once I've sold the straddle and I've waited a little bit and the wings have become cheap and I've bought in my protection on the outside, then left.
Is wait and pray.
But if I haven't bought the protection in and it starts
Oh,
to
then
move, then buy the protection in right away. Would that
yeah,
be the
but
thing?
if it starts to move, then you'd be, then it's a bit late. So like what I do is when I'm tightening the strangle, as soon as I tighten it into a straddle, at that same moment, I'm buying protection, those cheap units, right? And then thereafter, there's no more managing that trade because it has become a defined risk trade as opposed to an undefined risk trade. You have to manage actively undefined risk trades, and with defined risk trades, it's just a wait and pray approach. Because if you've already defined the risk, you've already risk managed the trade. There is no more management to do, right?
Right.
So there, if I roll in the strangle into a straddle, bought the protection, it becomes a defined risk trade. I just leave it there. Just wait and see. Now, if price comes back to the center of or at the money again, several days or a couple of weeks later or whatever, and it becomes highly profitable, yeah, I'm gonna snap it off, take the profits, and not wait until they disappear again. So I'm not necessarily gonna wait till expiry, but provided that that trade does not become profitable, yeah, I'll wait to expiry, no problem, and take the loss. But it won't be a net loss, or in most cases anyway, because I will have made all that money on rolling in the strangle,
Right. That was
which may
yeah.
or may not offset an eventual loss, defined loss, on the butterfly, right?
Exactly. Yeah.
And so and and then the next step is kind of interesting. You just so I have that uh, straddle with its wings or the butterfly, and then immediately thereafter put on a fresh strangle, which I have to manage and roll that in. Roll, keep doing, and it's the same thing. Now, when um, the days till expiry come below a certain threshold, given the implied volatility, all that, then I'll just go out to the next cycle, and then it's just a process. And that's what I said from the onset of this conversation. You have to understand that it's a process. It's not a single. We don't care about a single trade. A single trade is not a big deal. It's not going to blow you up, or you should. If it can, you're doing something wrong. And it's just you repeat the process. And every time you put on a fresh short vol trade, it's not just random and it's not just a set number. Oh, I'm going to write out, $5 wide or anything like that. You got to look at the vol skew, the vol surface to determine which expiries are the best, which point in the skew is the best to sell, which point is the best to buy, and so forth. But just repeat the process, repeat the process.
I think it's a really important point for people to understand that um, this sort of strategy is you can't really judge the success of it overnight. You need to
No way.
learn to put it on. You need to learn how
Hmm.
to there's a big difference in the world between conceptually understanding something and actually executing it. And
Hmm.
you need to learn to put it on, learn to execute it, and you need to have enough occurrences for your returns to end up starting to match the expected returns.
Absolutely, and that is key. And that is key to short volatility trading is number of occurrences. Just like volatility adjusted sizing is the key to trend following.
We used to give an example on the floor, which was like uh, it's kind of the opposite of it. But what we would say is, if you had this was a question also for interview for traders. If you had a chance to either play Michael Jordan on one, one time or 50 times in a row to see who would win, which would you pick? And
One time,
yes, exactly, because you might get lucky.
yeah, but you're not going to get lucky 50 times.
Right, and it's the same with doing a trade that's 80% in your favor. You might get hurt for that 20% one time, but you're not going to get hurt in the 20% 80 times.
That's right. Yeah. Yeah. Well, yeah. And it, I just wish this message would be accepted by guys, understood and accepted a lot quicker than I perceive it to be understood and accepted. Because so many guys out there are concentrating on entry points, exit points, and trying to predict the market. Whereas if you have some statistical analysis to deal with, like especially in options, it's so easy. It's there. The analysis is in the option price when you put on the trade.
It's been figured out for you, yeah.
Yeah, you already have the probabilities right in front of you before you put on the trade. So you don't have to worry about if you get into it, at 1510 or 1525. It doesn't matter. What is the probability? And if you repeat it, your portfolio is going to reflect that probability. You know.
Yep. A lot of people come up to me and say, "Oh, the stock market it's gambling. It's going to the casino." And I try to explain to people, well, in the options world, we can actually move the odds into our favor, and
Hmm.
that's what adding, as like a strategy like yours of starting with strangles, collecting some money and slowly moving in, you're slowly adding edge to your position. You're
And
slowly,
taking profits.
yeah, you're slowly adding the probabilities and stacking them up in your favor more and more. And
Oh, and hold on.
yeah,
Also, by recentering your deltas to neutral, you're reducing the risk each time as well, momentarily.
and so um, when people criticize me working in the stock market, I explain, well, there's more going on to it. Yes, if you're picking a stock and saying this stock is going to go up or down, that
To
is
the
really
moon.
that's really a crapshoot. And but
Yeah.
you know the public, everybody wants immediate gratification. That's why someone comes in and buys a UVXY or a TVIX because they think, wow, I could get
Hmm.
lucky today, and this thing, if the market crashes today, I could make 8,000% or whatever, and that's true. But that's not
Yeah.
how
Yeah.
people make money day in and day out.
No, as a professional in the business, I cannot even entertain that type of thinking. Yeah. I'm like, yeah.
Yeah, I can't go to Las Vegas. People say, "Oh, you're in the trading business. You probably want to go to the casino," and
I hate casinos.
maybe for fun, I guess. But the thing is like the odds are against you in that situation. And why would you
Yeah.
want to do something where the odds are against you?
Yeah, I've only been, a lot of people think, oh, traders are like gamblers. Yeah, you're absolutely right. And I must live. I hate casinos. I think it's a terrible waste of money. I think it's stupid. I've been in casinos all of 4 or 5 times in my life, and most of the time I spent at the bar. You know?
Well, I was out of the trading world for a long time and had to take some rough jobs. One of them, I was working in a gas station,
Hmm.
and the the there was a line of people out the door, and I'm not exaggerating, to buy scratch tickets and lottery, and that was our famous.
That's what the poor do.
And it drove me crazy.
Yeah.
They would tell me, no, 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 this ticket, it came up last week, so it's going to come up again. They had all these theories, and I tried to tell them, but it would drive me nuts having to stand there all day and watch people who can little afford it give away their pennies to the government.
Yeah, well, not to be an asshole, but poor and stupid often go together. And not to be nasty. And there are a lot of poor people who are bright, very intelligent. I'm not saying that if you're poor, you're stupid, but it often goes to pair because, I mean, who buys lottery tickets? Definitely not successful people I know. I don't. The guys who you see in the shops buying lottery tickets are, generally I'd say the welfare class buy them even more than the working class.
Well, there is a graph which showed education level versus lottery ticket purchase, and MBAs don't buy lottery tickets,
No, no.
uh, and it's really a culture, um, and in a sense, if you're in a really desperate situation, uh, in a way, buying a lottery ticket may be your only shot. I mean, but
Yeah, well,
and it's fun. I've bought a scratch ticket for like someone to give for their birthday or something, but
yeah,
literally
like a gimmick, sure,
we
but
saw
not as an
addicts though.
activity.
We saw addicts of like people that were actually the middle class, maybe even a doctor or something or a plumber who was spending $100 a day on these scratch ticket things, and it's really
Yeah, well, that's
sad.
just a bad habit. This is an addiction and a bad habit. I mean, I have addictions and bad habits too. Like I smoke, I drink, smoke joints a fair bit. That's actually good though. But yeah, in regard professionally speaking or in finance, I don't go to casinos. I don't buy scratch card tickets. I don't go long volatility. Huh?
Well, people are coming out of the woodwork right now who are long volatility, and this is it's one of those things where this has given everybody hope in the long vol crowd, and I've actually seen some serious market professionals saying that like it has been possible to be long gamma in the last for that one day or for that couple days when the markets were moving a lot, and
Mhm.
the only long vol trade that has worked has been to be long ES calls. I mean, over the last while, and even that is it's only because of the delta. It's not because of the gamma. So
Not because of the Vega, you mean?
I just mean that like yeah.
Yeah,
Well,
yeah,
I was talking about like buying SPY like relatively close to expiration, at the money calls has worked just because stuff's moved up.
yeah,
I don't
yeah.
know if big intensive ones have worked. Yeah, if you held them till that one day, but probably the theta, even though it's small of farther out options, probably would have balanced out what you made on the vol move
Right. Yeah, 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 yeah.
eventually.
Uh, but we're in an interesting world. It's always interesting, actually. Sometimes it feels uninteresting, but you know what? When we were in that extremely low volatility environment that we saw near the tail end of 2017, and everybody was just bored out of their head, saying, "When the hell is vol going to come back?" That was actually kind of an exciting time because that was a black swan event, you know? I mean, it wasn't the scary, nasty black swan of a vol spike. It was the opposite. It was the black swan event of excessively low volatility, where, if you were short vol, you're making money every day, every week for months, you know? And I was a bit short vol, but I couldn't bring myself, to be honest, and maybe, well, retrospectively, it was a mistake. I should have kept plugging away at it with simply wider strength. Okay, I would have made nickels and dimes, but it's better than sitting around counting the flies on the wall. You know?
I um I want to go back to our last conversation since once again we didn't really get it down on tape because I wanted to bring up this point with you again and ask you what is your impression of the United States and what's going on politically here as far as the phenomenon of social justice warriors and this sort of phenomenon because I'm curious as to what
It's crazy.
you
I,
see it
I,
as.
I never, I was born in 1970, and I would have, throughout my life, I never would have imagined a society in which people get so uptight about stupid crap, you know? And I thought I would, like, back in the 70s and 80s, we lived in a pretty, decent place. And I thought people were becoming more and more cool, actually, because when I was younger in the 70s, the hippies and everything, when I was a wee child. And then later, we had the punk rockers and everything, which I enjoyed. And people were just, yeah, a bit rebellious, but open-minded and cool, Now you get the opposite, and they think they're cool, and they're all about, don't be mean to fat people, don't tell gay jokes, uh, you know, uh, I mean, but it's become to the point where if you have a nice, strong, healthy body, you're some white male fascist or something. You should be fat and gay. I mean, come on. What does it come to? It's beyond belief. And the cause of what's the cause of it? I can only speculate that it's pure stupidity.
Well,
you know?
the pendulum swings back and forth. Someone put it as like back in the '70s, it was the comedians all would make fun of conservatives and how square they were and all this stuff. Now all the comedians make fun of how overboard the social justice warriors have gone. I mean, if you wear a certain hairstyle in the United States, like if I were to wear dreadlocks in my hair or cornrows, I would be accused of cultural appropriation and not be allowed,
What is that about? Yeah,
and attacked. It's a strange
I know.
environment.
I figured too. I just had we live in a village here, kind of town. Not many people. I think the population here is 9,000. Okay. So it's quite different from the big financial centers where I spent most of my life. And here there's a smaller population. So my wife and we have to be more open to mingling socially with people who we might generally not in a bigger city. And a lot of the people here are lovely. Some of them are highly intelligent. Most of them are not. But I had this young chap here who was just telling me the same thing about this cultural appropriation and shit. And I said to him, well, yeah, well, were it not for this, what you call cultural appropriation, the entire planet would not have benefited from Louis Pasteur's research in Paris,
Yeah.
Louis Pasteur,
Yeah.
he
Yep.
invented a whole load of pasteurization, first of all, and vaccines and so forth. Well, had China and every country in Europe or America not culturally appropriated this French technology, you'd all be without vaccines and sterilization.
Yeah, I mean, and every white kid from the suburbs in the United States likes to listen to rap music, and U.S. is supposed to be a great mixing pot, but it's turned into, you know, I don't know. Like I said, it swings back and forth. But
Yeah, and and this extreme case of this social justice stuff is, I don't know. I think you're probably neck and neck with maybe England or New Zealand or Australia, but it seems to be a very specific Anglo-Saxon country phenomenon
I think it's Canada
because
too.
yeah, well, Canada is the epitome of it too. Oh my, don't even. I was born in Canada. I know Canada well. Don't even get me started with Canada.
Trudeau is the poster child, I guess.
Oh, what a guy! What a guy!
So let me just ask you. I don't want to take too much of your time, but I heard you're working on a book.
Yeah, yeah.
What's that all about?
It's about trend following and volatility trading, and it's what I. The reason why I thought, okay, it's time to write a book. Well, it's twofold. For on one hand, I've acquired a lot of knowledge in trading over my life, and I'd like to share it, okay, for posterity or whatever. But also, more practically speaking, of all the books that are out there, there seem to be very few which are actually cover a bit of theory, but not too much, like but really practical stuff that you could put the book beside your computer, read it, and start trading. You know, that's what it's aimed to give people the mechanisms and the understanding of these mechanisms, so that they can actually understand what's behind the trade and why they work and which principles work and which principles are rubbish, and then actually go through a step-by-step method, like I just explained to you, with the trading the large triangle, for example, step-by-step method, and it's actually you don't have to be an engineer or a quant to understand it. So it's a methodology on one hand, but I also cover a fair bit of principles in it. It's a bit of theory, but it's not boring theory. It's quite interesting. Maybe I can pull up a little piece of it just to give you an example, if you'd like.
Sure.
Yeah. Uh,
Yeah, like as you can see, I've been trying to recruit you possibly to help me with a website at some point because I want to give people more options as far as helping them with strategy with the volatility. There's
right.
there's some good stuff out there, but we could always use more as far as uh, options, trading options.
Yeah. So here I have a chapter. It's called General Guiding Principles. Excuse the noise. It's Nikita Louis and Valentina playing, I think.
That's fine.
General guiding principles. And then I have a number of subheadings. For example, trading is not forecasting the future. There are no secrets. That's a big one. That's interesting because sometimes you'll discuss some trading with someone, especially on Stocktwits or social media or whatever, and they'll say, "Oh, I'm doing this," and I said, "Okay, why?" "Oh, because my model said so." "Okay, what's your model based on?" "Oh, I can't talk about it. It's proprietary."
Right.
Like, come on. First of all, the biggest, most successful hedge funds on the planet publish their trading methodology. There are no secrets. There are principles which work and those that don't work. If you think you have a secret, you're either not aware of what everybody knows out there, or you're delusional.
I
You
think
know?
I think some of these people are just trying to market their pay services, and they're like, "Oh well, I can let you know the knowledge if you know." It's been like that forever. It seems like the Wall Street, where like people pretend to have this secret knowledge that only they can trade the stuff for you because they're trying to get you to give them their money. It seems like.
Yeah, yeah. I mean, the only real secret knowledge that does exist out there is insider trading, which is illegal to trade off of, and which doesn't apply to me anyway, because oh, I saw the most hilarious, speaking about these secrets in insider trading. I saw one guy on Stocktwits alluding to the fact that he had inside information into volatility derivatives because he had lunch with a guy from ProShares. So somehow, some guy from ProShares give him insider information as to where vol is going in the next 2 weeks or whatever.
Wow.
Like,
Like so that guy knows, huh? If you work for ProShares, you know where vol's going. Well,
yeah, yeah, apparently so. Yeah, that's one principle here is there are no secrets. So don't look for them. Don't waste your time trying to figure them out. Then of course statistical edge, whatever.
well, I like that first one about not predicting because the most
Yeah,
common question I get on StockTwits is what's going to happen tomorrow, and I don't spend any time thinking about that. And
I don't either.
yeah, because
Zero.
how do I know first of all, and second of all, why should I bet on something that's impossible to figure out?
Yeah, it's like I treat it like the weather. If it's sunny, I'll put on a t-shirt. If it's rainy, I'll bring an umbrella.
Yeah, yeah.
You
It's
know?
it's just something people have to get past, I think.
Yeah, yeah, yeah. Prediction is just like, in my opinion, futile. And I'll just read in fact, a little paragraph of the introduction. And this is still in draft form, so it may change from the time it's published. But um, here, listen to this, Dave. The fundamentalists, or value investors, are an entirely different species who drink an entirely different brand of reason. I wish them well, but I cannot quantify their success precisely because they employ a great deal of subjective analysis into their process by cherry picking which metrics are most important. In most cases, I believe, they confuse the prowess of their analysis with a bull market.
Perfect. Yeah, it's very true. I mean, so many people have only been in a bull market. They showed up on the scene. They got long X stock, and it went up, and now they're a genius.
Yeah, and showing up in a bull market is like 90. Like, have you looked at the S&P over 100 years, or like it's a bull market permanently, except for big dips that are relatively ephemeral, right?
But it seems like definitely the idea that XIV and these products are a substitute for the S&P has been questioned a lot with the XIV going to zero thing.
Mm-hmm.
Okay, so
And
what else? What else? So,
let me just see. Yeah, I put in. We already discussed this. The law of large numbers. That's an important principle to work off of. You have to repeat your process. If you have a process or a trading model that's at least sound, it has to be repeated day in, day out, or week in, whatever time frame you're on, or you're not going to obtain the results. What else? Diversification. We talked about that a little bit. Diversification is an invaluable risk management device. Yeah, it's risk management. You want to be diversified. Um, and again, diversification is not 20 different stocks in a portfolio. You're just equities in that case. Um, the fact that a lot of guys kind of, especially the really new traders, they talk about win-loss ratios. Um, Win-loss ratios are not all that important because a win-loss ratio, if you see a win-loss ratio, you win, you have profitable trades 80% of the time and losing trades 20% of the time. That's fine, but the other facet of that same question is what are the probabilities, right? Or no, sorry, what's the amplitude of the gain or the loss?
right, because you could have one loss that blows out all your wins.
Yeah. So, for example, in trend following, and this is I have a win ratio in trend following of somewhere in the low 40%, you know? So I think it's like 43, 45%, something like that. And some guys will say, well, that's terrible. You must lose shitloads of money. Well, no, because you get 60% of small losses, 40% of half decent winners, and amongst those winners, you're going to have 5% of extraordinary gains. And you talk to any trend following hedge fund manager who's been around for a while, he'll tell you that between 5 and 10% of his trades make his year.
Well, I think we did talk about that last time. How you execute to, because once you get on a trend, you just stay there. Basically, the losses are just kind of getting your entry point correct.
That's right.
Getting on
That's
board
right.
the train, sort of.
That's right. Yeah, yeah, exactly.
You use trailing stop losses to enter a lot of these trades, correct?
No,
Or no, what's
for
it
the
called?
trend
I'm sorry.
for trend following, I just use on-chain channels,
Okay.
just like a million other fund managers, hedge fund guys do. And don't no secret there. It's on-chain channels, and yeah, you get whipsawed, but they're small. And if your position sizing is more or less calculated correctly according to the volatility of the underlying asset, you're going to keep those losses small. They're annoying, they add up, but they're not going to blow you out. And sooner or later, something is going to move like hell somewhere, right? There's another part, just more in on the theoretical part of the work I'm putting together, is dedicated to climbing out of a mathematical hole. Like, when you lose more than X% of your portfolio, basically saying that 10% up is not the same as 10% down. We know what that's about, but I thought it would be nice to remind the readers of that. Um, what else is interesting? Just avoid continuous curve fitting.
Well, don't give it all away because people won't buy it.
Yeah, yeah. No, but
You gotta tease it.
yeah, yeah. Here's I have a section dedicated to process over results. Just like I said, you don't worry about a single trade. It's the process that counts, as provided that the process is, reasonable. And then I go into the actual trading models that tell you from A to Z how to manage a trade. It's really simple stuff, and hopefully, I mean, there's a lot of technical jargon in there that you have to overcome just because I'm using appropriate language for the subject. But if you can get through that and even understand it, I think you're going to have a book that just makes good sense, And I think that when in any matter, whether it be, engineering, law, finance, or whatever, if you read a principle that just makes sense, it's usually a good principle, you know?
Yeah,
Some
the simplest ideas are the best a lot of times.
Exactly.
Yeah.
And keep it simple is like this completely applicable in trading. You don't need to have a very complicated trading model. In fact, having an overly complicated trading model is probably the worst of things because you'll never be able to detect what's going right or wrong in it.
What There's been a lot of talk with this the sell off on February 5th. People are saying essentially, oh, it's all over. We're gonna switch into, I don't know, a bear market. Something, everything's gonna change, and we're gonna go down from here. Um, it,
Maybe.
if that sort of thing were to happen, would it change the fundamental strategies that you use to make money? Would you say, oh, okay, well,
No.
we need to switch gears here, or is it still
Oh, you can
applicable?
switch gears. Yeah, a little bit, but fundamentally, no. My trading models will remain the same. The only thing it would change would be a bit of capital allocation readjustment and size of trades, really. I mean, because here's the thing about short volatility. Short volatility is decaying by nature. It's not just because the market doesn't like it and it's selling it off, you know? It's mathematically, inherently, necessarily a decaying asset. Those spikes in volatility are an anomaly, which we can profit from greatly, but volatility cannot go up for any prolonged period of time. And did I explain that previously? And because it's a very interesting subject, because what is volatility? It's a result of an insurance contract, right?
Which has a time limit on it, essentially.
Exactly. And if you take out insurance for your house or car, whatever, for 1 year, that insurance contract is necessarily going to be more expensive than a like-to-like contract for 10 days. So when that 1 year insurance contract will over time become a 10-day contract, right? Near
Yep,
the end of
yep,
its life,
yep.
and therefore cheaper. That's volatility. That's implied volatility. Closer you come to term, the less valuable it is in principle, except during the day or the week where there's a big fucking storm.
Yeah, that's one of the big misconceptions uh, about volatility. People will say, "Well, there's going to be a big unwind of things." What they don't understand is that so many of the things that we've done to short volatility have already long ago expired, and the money's long ago gone into our bank account. And
That's right.
it's not like it's all adding up to one big moment. It's like no,
No,
we've this expired, this expired, this expired. Down the line, we've collected money, and that money's off the
we've
table
already
now.
collected and spent most of that
Right.
money.
Right. Exactly. It's not all just sitting there waiting, and that is maybe one of the disadvantages of people trading these pre-packaged ETFs in that they are not putting
They're
on a
not
short
rolling.
options trade and taking it off. They're just letting somebody else do all the rolling, and so their profits are accumulating in one spot and not being taken off the
That's
table.
right. Zero diversification, accumulation of wealth and concentration of wealth without any diversification, because the only prepackaged volatility products that are out there are S&P Vol.
That's true as well. Yeah, that's true as well. And even something like VMIN is better than the XIV because VMIN declared a dividend of $10, and you got that $10 off the table in January. So if you've been trading VMIN, as long as you didn't reinvest your dividends, you were taking it off the
Mhm.
table a little bit. But anytime
Yeah,
you have an investment like XIV that it says, I think in the prospectus, this is a short-term investment. Anytime you take a trading vehicle and leave your money in there over a long period of time, you're doing something with it that it wasn't meant to be done with. And
that's right.
yeah,
And diversification again is if you know how to construct your own short volatility trades, you have a whole universe to deal with. Okay, more and more these days they're going kind of together, but there's still a lot of merit to diversification. For example, you remember several weeks ago or a few weeks ago, I was big into the nat gas short vol trade, and it worked out wonderfully. Then the equity short vol trade popped up, and now I'm into that heavily. I'm also
oil,
into
right, or something.
I'm into oil as well and copper. I have short volatility on oil, copper, equities, like a number of things, you know.
I was talking with you before, just quickly before we go. Can you explain to me with options how we could replicate like a UGAS with natural gas options? You were explaining that to me a little bit. How like we could sort of do the same thing as being uh, we were talking about being short both UGAS and DGAS at one point, and how
Yeah, yeah, that's
not
interesting.
that's not
And
economically viable because of the
yeah, just
carry
because of
and
margins and so
yeah,
forth.
yeah.
I mean, those short the leveraged bull and bear ETFs. It mathematically it works, but it's kind of similar to just being consistently short a strangle or a straddle. Okay,
Right.
is and I'm certainly not mathematically inclined enough to explain precisely why the profiles of these short leveraged ETFs, if you put them short both of them simultaneously for the same exposure on each leg, give an approximate equivalent of a short straddle. Mathematically, I can't explain it. I just don't have the mathematical knowledge. Okay, but
Let's just
they're
say it's
very similar.
similar. It's similar. Yeah. I mean,
It's similar.
yeah. Yeah.
Yeah. So you're going to have a profile which, if you were to just, every week put on a new straddle, okay, and not manage it. That would give you approximately the same profile as shorting the both leveraged bull and bear ETFs, meaning that you're going to have a P&L curve that slopes up gradually, takes a sharp drop, bounces back up relatively quickly most of the time, and continues on an upward slow curve, you know, and that's okay. It's good. But my point was that you can engineer it better and make it more economically viable with options to get a very similar, if not identical, risk profile.
I was that was really interesting. Last time I talked to you, that you were saying, well, I'm short, essentially short straddles or options in natural gas, but it's kind of moved to the upside a little farther than I would like it to. And the day after I talked to you, natural gas was way down,
Yeah,
right in
yeah,
your
yeah, yeah.
favor. That was awesome.
Yeah, so you just had to, that's what I call taking the heat.
Yeah, you just
If you want
you
to,
hang out long enough and it comes back. In that case.
nothing goes up forever or down forever. These things never move in straight lines. You just have to be sure that your size will is small enough that you can survive or even add more on.
And when
E-
people get familiar with a specific product like natural gas, you know that acts that way. I mean, it's sort of seasonal, but the price of natural gas is not going to go to like $10 or something and stay there. It's going to be between, I don't know, 2 and 5 or something, and it's going to, or 2 and 4
Yeah,
or
I mean,
something.
it used to be. I remember when I started trading natural gas, it was up in the 12 or
Oh
$16
wow,
range. Huh?
oh wow.
Yeah. And that was, I told you the story about Amaranth, which is a big volatility fund in Canada, and they blew up. And ever since they blew up, and they actually, by unwinding a lot of the positions, they brought natural gas down. It just never came up. Now, I'm not saying that nat gas has become down in these figures because of them. It just coincided. And then also I think it has a lot to do with the uh,
It's like increased production,
extraction.
right? There's been increased extraction and production since then.
Exactly,
Yeah.
exactly, and that kind of thing. Natural gas is a wild animal, and it's changing. And people say, "Oh, the market's changing." Yeah, well, that's what the market always does. The market is always changing. You have these low vol periods, high vol periods, bull, bear periods, consolidation, crazy zigzags all over the place. Markets have always done that. To think the market is doing something new and funky is just look at a really long historical chart.
Well, that's what everybody says every time. Every time something goes against them, they say it's a new paradigm and it's a new market and it's all
Yeah,
changed. And
yeah. No, we're just going into a different, like right now, I think in volatility, we're going into a higher volatility regime. I'd be surprised if we see volatility at 9 or 8 or 9 and 10 on the VIX, for example, anytime soon. It's possible. And if it does, I'm going to deal with it. I'm probably going to make some money off of it.
I want to.
But right now, yeah, we are in a higher volatility regime and will probably stay this way for at least a number of weeks.
So I want to just ask you about that for a second. Uh, it's sort of maybe an easy question for you or obvious to you, but we look at the term structure in the VIX term structure. I tend to look at this VIX Central, and
I didn't even look at VIX term structure today, but let me take a look.
yeah, I will put it up on the screen for our guests to take a look at here. Yeah, look on your screen because it's hard for me to put it up on your screen, but I'll
Yeah,
put
okay, I see it. So I see, for example, on the February, okay, I have the weeklies in there as well, which are they don't really trade, but I have February 21st at 1830, Feb 27th at 1820, so a little bit of backwardation,
So
and then
my question is, the uh, the spot has been higher than the futures for a while. Is that normal? Is that going to stay like that? Because I was thinking that like spot would go down below the futures at some point. Uh, for the VIX,
um,
what does that mean when? Because the whole time since the whole last year, spot was lower than the futures prices, and uh,
yeah, well, that makes sense. That makes entire sense because when spot is excessively low, say when VIX was trading around, we were down at 8 and 9 kind of thing. There's there's a floor there's a floor in volatility. On the S&P 500, I believe that floor to be somewhere around 5%.
Okay.
Volatility cannot go below 5% on the S&P. If it does, that means nobody's trading anything anymore, really, right? And it's just not
Yeah,
moving.
yeah, I would say that. Yeah, I mean, the low in the VIX is in the eights, but actual volatility can get low, but option prices are not right exactly. It's not going to three or something.
No, no. And so when the VIX, which is, spot implied volatility of the S&P at the money or near the money strip of options, when that is so low, obviously the futures market is a forward-looking market, right?
Right.
So the forward-looking market simply says, well, it's so bloody low now. We know that we estimate there's a floor just underneath where we are. It can only go up. So obviously the futures prices are going to be trading higher than that spot. Now, in higher volatility regimes, like we have right now, for example, it's completely normal that the futures guys who are forward-looking, right, say, well, implied volatility decays, so we're going to go down.
So if I'm a retail guy and I'm looking at the term structure right now, is this
Mhm.
tradable information? Should I say to myself, oh well, the professionals are thinking vol is going obviously lower since spot is higher than the futures market. So
Mhm.
so I should probably be short volatility here. Is that a reasonable way of looking
Okay,
at it?
now, yeah, well, here's the question. Do it like if you look at the term structure of the futures, and then you decide that vol looks like it's headed lower according to the futures, then what do you do? What do you do? Go sell the futures? Well, they're already low,
Hmm. Oh, good point. Oh.
you know, and that's where and as I've been, wrecking my voice screaming this several times over the past week, is term structure does not dictate price. Price dictates term structure. Okay? So it's not a question of it's asking, does the dog wag the tail or vice versa? In this case, we know that price determines term structure. If front month goes up in volatility derivatives, you're going to have a backwardated structure. Now, if it were the inverse, if let's just examine this hypothesis according to some naive guys who think that term structure dictates price. Okay, let's back up to when VIX was in contango. Well, then, according to that thesis, well, contango would prevent prices from moving higher. But the VIX spiked, so that's not true. When it spiked, term structure went into backwardation. It's dead obvious what's taking the lead here is price, not term structure. Term structure is a result of price movement, not the inverse.
And
And
that's
that's what
yeah.
and that's what a lot of the younger volatility traders here seem to confuse is like, products like UVXY have a lot of headwind in them because of the fact that the term structure is in contango 80% of the time. But don't be confused. It's not because of the contango the prices are going down. It's because prices are going down that there is contango.
Yeah.
And it just so happens that you roll that and you use it to your advantage. But price dictates term structure, not vice versa.
And the other point which I always like to make is that when you see something on the screen and you think, oh, there's a huge opportunity there, this is mispriced, you're probably, if you look at an options market and you say, oh, the market makers are really mispricing this, here's a huge opportunity to do something here, you're probably not understanding the full picture because nobody leaves out huge amounts of money to be made on Wall Street for you to just grab out of the air.
No. And you know what? When one options market maker does make a blunder, or if he's visibly if his skew is visibly exploitable, don't worry. There are 20 other firms that are making the same market that are going to correct him pronto.
Yeah, I mean, I've been in the pit before, and I'll turn to the guy next to me and trade with them right away if I don't agree with them.
Yeah.
We had program traders in the pit who had they were trading a huge portfolio and they had these computers strapped around their necks and they would trade actively with us all the time because they were doing different stuff than we were. And
Yeah.
in the end, don't worry about what other people's markets are. Well, you have to worry about what other people's markets are because maybe you're not understanding it right. Uh,
Mhm.
but yeah, like you said, if there is like a free money to be made there, it's not just going to sit there. It's gonna be arbed out of existence real quick. So
Yeah, and but sometimes what's interesting, yeah, if there's an actual mistake out there, it's arbed out of existence immediately, and you don't even need a bright guy to see it because computers are doing it every millisecond. And what's another interesting thing, what I saw back, I think maybe you recall me pointing this out, but I was examining the VIX, sorry, the UVXY term structure. Uh, on Stocktwits with some chaps last week or when we had this big vol spike anyway.
yeah,
And I pointed out that there were actually points in the term structure where at the money had more implied volatility in it than out of the money calls. And so you can actually that's an exploitable thing to take advantage of. Well, you sell at the money at the highest vol, which is well, it wasn't the highest, but it was high, and then out of the money was actually cheaper, and so it's essentially free protection.
well, that's a great point. The skew in UVXY is opposite of like the SPX or something where the out of the money calls are the highest volatility and the puts are the lowest. The out of the money puts can be the lowest volatility. So if you buy a call spread, you're maybe
Hmm.
buying an at the money volatility of 140, and
Hmm.
the buy part you're buying a 140 vol, and the call you're selling might be a 200 vol. So it's a cheap call spread to be buying, and we know why that is. It's because people want to buy those out of the money calls so much that they're skewed up. But still, if you need to buy protection to the upside, you can buy a cheap call spread there, and it's like in the model.
Yeah, exactly. The skews on the underlying equity market and the vol derivative market are opposites. Yeah, because on the natural hedgers on the equity market, they're long stock, and so they want the protection on the puts. Hence, equity index puts are often skewed more expensive than the out of the money calls. But on the vol market, it's just the inverse. We know that volatility is a decaying asset, therefore the the um, the puts are priced accordingly, and we know that there can be eventual spikes like hell, and that's why the calls are really much more expensive than the
Well,
puts.
yeah, that's a good way of putting it. The danger is for a spike to the upside, so the skew is to
Yeah,
the upside in UVXY, whereas the S&P, the violent move would be to the downside, so the skew is to the
that's
downside.
exactly right, and that's why the skews are opposite.
So what are you seeing in Europe about Bitcoin? Are you interested in Bitcoin?
I'm fascinated by Bitcoin. I don't have any positions on it. Don't intend to anytime soon either. I'm fascinated by it. Well, from a couple of points of view. First of all, because it's technologically interesting with the blockchain and all that stuff. Also, I really, as a as a libertarian, I suppose, I really love the fact that they're giving the banks and specifically central banks a little bit of a challenge. Maybe not a real challenge any this week, but there's another non-governmental force out there, which is gaining clout. And Bitcoin's not going to go away tomorrow. It's going to be around for a while. It's just it's been around and adopted by, I'd say, a critical mass already, which will maintain it into existence for at least the foreseeable future. It may end sooner or later, but it's not going to end tomorrow or next week.
Do you think the government's going to stamp it out or try to stamp it out?
I don't see how they can. I don't see how they can. As long as you have an internet connection that's not completely censored, and encryption capabilities, which is widely available even to the most unsavvy IT idiots like myself, you can deal in it, you know?
Well, you're pretty good. You're
Um,
pretty good with IT. Look at that massive screens in front of you.
oh, I look like I'm a brilliant. A lot of some guys who come here and they don't know what stock market is. Oh, you must be in IT. No, not at all. I know nothing. No, but the Bitcoin is quite interesting, David. And what? Okay, he's actually our mate, Ron Turkey. He's a good chap. I like him. He asked me why I don't trade in Bitcoin, and I said simply because on the OTC Bitcoin exchanges, those exchanges are so Mickey Mouse. I mean, there's no circuit breakers or anything. Look at the ether drop to near zero in
Right, that's
a
a
few
famous
minutes.
famous case. Yeah, I went to what 20 cents or
Yeah,
something. Yeah.
yeah, and I look even on the Bitcoin markets. My associate in Dublin, he's following it. Like he used to be a professional floor trader in Chicago, but he dabbles in Bitcoin just to become familiar with it because it excites him or whatever. Um, but all the exchanges, and he's verified. He's told me this as well. He said they're all Mickey Mouse. Like the mechanisms in the exchanges are Mickey Mouse. The clearing mechanisms are Mickey Mouse. The rules and regulations are essential, almost non-existent, and there's no liquidity. Him and I, we used to work in FX together, where we'd see, 50 million on the bid, 50 million on the offer
Wow.
every minute of the day in the foreign exchange world. Go into Bitcoin, which is supposed to be another currency, and you see like 20,000 on the bid. I go, huh.
And you have to think that there's big guys that are pushing the markets around, spoofing the markets a lot. Like a lot of those bids are fake, probably. It's guys offering stuff. I mean, you got to think there's people playing games out there with that stuff.
Yeah, and that's fine. I don't even care about
Yeah.
that. I don't even care.
Right.
Which brings me to a subject, and I'd like to interview you a little bit here, if I may turn the table for a couple of minutes, regarding specifically market makers. Okay, as you probably see me say on a few occasions, and maybe it's a bit harsh how I put it, but I've said on a few occasions in public. Uh, Often those who complain and cite market makers, algos, and market makers, algos and manipulation are cited by those who simply can't trade, right? And there's this perception by a lot of the probably more novice traders that the market makers control the market. They just, you're a market maker, okay, you're king of the castle, you decide where the S&P is going today. As a former market maker, David, what are your comments on that?
Well, first of all, initially, a lot of the paper that comes through the market maker, we have to make a market. We can't choose what we want to trade a lot of the time,
Right.
and that's a little bit. It's changed a little bit now with streaming quotes, but essentially, we have to take the other side of a bunch of trades, and most of the people who are trading with us are not the retail customers. It's smart money.
Mm-hmm.
A lot of times it's insider money or wired money, and if they want to buy if they know that a company's getting taken over and they want to buy a bunch of calls, well, guess who's selling the calls to them? Me. So as a market
Yeah.
maker, you're usually stuck with like the worst possible positions, and you got to figure out how to weasel your way out of it. Um,
That's very well put. I like how you explain that, David.
but we stand there. I mean, we would sit there in the pit and say a similar thing to what these people are saying. We would say, boy, those guys upstairs are controlling everything. I wonder what's going to happen. We felt like we had no knowledge of what was going on, and we were just standing there waiting to get picked off by somebody. So,
Yeah.
yeah, yes, market makers can make money, and you pay a heck of a lot of money to stand there to have access to better information. And by better
Hmm.
information, I mean that if you get to see every order that comes through, you can get a better sense of what's going on than if you're just sitting at home. It's hard to pull
Yeah.
up time and sales and figure out who the buyer. Even with like Thinkorswim, if I pull up the time and sales and try to figure out what traded, it might be mark spread or something, but it's hard for me to figure out who the buyer of something was, who the seller of something was.
We have no idea, in fact.
Yeah, yeah, and when I first started trading, we had something called single issues, where like any option in the world that was traded in X stock went through our the three little people that were standing there. And in that case, we had some advantage because we were able to. We knew that every month Joe Schmo from Goldman was going to come and roll this calendar spread. Uh,
Yeah.
or
Okay. Yeah. Some trades have a specific footprint on them where, yeah.
and so
Yeah. Sure.
we could anticipate that and act accordingly. We also had the bid offer spread, where which used to be wide. We used to trade
Yeah.
in options, so we would be okay. We're 3 1/4 bid at 3/4, and there were certain market widths that we had to adhere to, but things were wide, and so sometimes someone would sell you something on the bid or buy it on the offer, and if you
Yeah.
just traded on the wide markets, everything would kind of spread itself off. But
Yeah.
in many cases, we end up stuck with an unadvantageous position. For example, who would want to be in there when that spike happened in UVXY and everybody's coming to buy calls and you've got to sell them? You can keep raising prices, but you have to stand there and be the counterparty. So there's opportunities, but there's also it can be very painful being a market maker.
Yeah. And that's a myth that I'd like to dispel. Is that market makers, not only do they not control the market, they're obliged to take the shittiest positions in the world
And
as well.
it's a little different nowadays, though, because the average equity market maker streams quotes into the market. So if they don't, if things get out of hand for them, they can just turn off their computer and they're gone. There's not as much
Yeah.
responsibility now to do stuff. But if you think about market makers as people that provide liquidity as opposed to somebody who's taking liquidity, if you're coming in as a retail customer and you're selling a call or buying a put, you're taking liquidity out of the market. You're
Sure.
not giving a two-sided market.
Right.
A two-sided market is what a market maker does. They say I'll buy it at this price and I'll sell it at this price, and it's pretty tight in between the buy and sell price. And
And the market maker doesn't generally take the direction into much consideration. He may skew his book a little bit to the delta positive or negative, but generally speaking, the ideal position of a market maker is delta neutral, right?
correct, we had stuff delta neutral, and typically when we do a trade, like let's say someone comes and buys calls from us. So I sell a call that makes me short some delta. I'll generally turn around and I'll buy the underlying wherever it is. I might try to finesse it a little bit, but as soon as I sell someone calls that gets me short, I'll go in and buy the underlying to flatten
Hmm.
out, to stay delta neutral. Uh,
Yeah.
because if you're trading a portfolio of 75 underlines, you don't have the ability to like make a decision
Analyze
like
each
right, like do I want
underlying.
to be
Yeah.
long this. Of course, as you get to be an expert in these things over time, you might have a little bit of a position, but as a market maker firm, you don't want people being cowboys and taking positions
No.
delta wise
No.
on different stocks, because there should be enough inherent edge in the bid offer spread and in the way you move markets to make money without worrying about deltas. What
Hmm.
what a market maker does is they participate in price discovery. And what that
Yeah.
is if we have buyers come in, we're going to raise volatility until we get sellers on the other side. Typically, we're not
Yeah.
going to take a stand. We're just going to move prices until we can find a balance of customers where we have
Yeah.
buyers and sellers on both sides. So,
If you have huge flow hitting one side of the order book, you're gonna adjust accordingly until it subsides.
right, and we're not going to take a stand on where that is generally. We're going to keep
No, no, you're not
moving.
gonna initiate it. You're just gonna act in consequence, right?
Right, we're just going to keep moving until we have buyers on the other side if there's sellers coming in. And now, market makers will anticipate things. Like, for example, if you have earnings in a stock, the day after
Oh,
earnings, when we come in, we will take vol
you crush the
down.
volatility,
Right, we'll
yeah.
crush it, anticipating uh, the people that bought options ahead of the earnings coming in and getting it back out of them.
But is it actually you crushing it, or is it the order flow causing you to crush it?
Well, I mean, sometimes if you see the similar pattern over a long period of time of volatility doing something, you would move it to anticipate it to some extent.
Okay. I suppose it also depends on how liquid the underlying is, because if it's not a liquid underlying, then you can control the vol as a market maker more easily than So, like, if you're a market maker on Microsoft, you're just reacting to the flow, I believe. No?
Right, right. And a lot of times there'll be other people in the pit that have different opinions than you do. And for example, if I'm long,
Hold on, you're telling me the guys had different opinions than you? They are idiots.
now people will have different opinions on things, and uh, sometimes if they're very small, then you'll trade with them.
Yeah.
They want the volatility lower. You'll say, all right, well then we have a trade. I want to buy it, and you want to sell it. How many do you want to sell? And you'll there were a lot of games that were played in the pits of uh, bullying and moving stuff around. But in the end, it comes down to pricing and
Hmm.
price discovery. And we try to manage our risk like anybody else does.
Yeah.
Um, if in illiquid issues, it can be very difficult because you only have a certain amount of players, and so you have to be very careful with your pricing because if someone's going to come and sell you a bunch of calls, you're stuck. You're holding those calls. There's nobody to turn around to and sell them out to. So you have to move price and be aggressive with it. And sometimes customers don't understand that, but our we have to stay in business first of all. And yeah, market makers have made a lot of money. Market makers have also lost a lot of money. It's not just that people are printing money and
Yeah, you're absolutely right. You know what? My experience, I've never been a market maker myself. The closest I've ever come to that is me, myself, not as an official market maker, actually going and placing bids and offers on ETFs when they first started coming out. In fact, the less liquid ones on the London Stock Exchange. And to my surprise back then, that was many years ago, I had my broker call me who said, "Yeah, the exchange just called us and you're manipulating the price." Because I was actually making the market on the new, back then, nat gas ETFs.
I don't understand why that should be illegal because you're making a tighter market and providing liquidity.
Apparently, it was an LSE rule that you're not allowed to have a bid and an offer in the same market simultaneously if you're not a designated liquidity
Okay.
provider.
All right. All right. So they're just trying to
They're
protect
trying to keep the
the
monopoly of
price of their
their.
badge or whatever. Yeah.
Exactly,
Yeah.
exactly.
Well,
Um,
there's examples
but
today of that same thing. Like there's an underlying drip, or even VMIN. If you look at the option prices in VMIN, they're ridiculously wide, and I could make a market inside there and make money, I believe, on the bid
yeah,
offer.
the American or the American options exchanges will not permit you to put a simultaneous bid and offer from the same account on the market.
Yeah, they're trying to protect the
Now,
price of badges. Yeah.
yeah, if you and I collude, we can go do it.
Right. Right.
It wouldn't be legal, but we can pull it off.
Right.
Yeah.
In a sense, it's a hard, it's a hard thing. What I do find that's interesting with making markets is a lot of times when you look at wide markets, especially let's say it's 10 o'clock in the morning, a number's about to come out. They'll widen markets out, and you'll see a wide market on the screen in an option. Uh, there's actually an inside market there. It's just not being shown. And
Yeah.
so, if I'm interested in buying an option, sometimes uh, uh, I'll try to figure out what the inside market is because you don't
And
necessarily
how do
have
you
to.
do that, David?
Um, I might offer, or
Because
bid.
I do it myself. I'm just asking how you do it.
Um, I might come in with a one lot, and
Yeah.
now the thing is like people might say, okay, well you're spoofing the market, but no, the one lot that I offer is
You want
subject.
it.
Right, it is a valid order. If it gets filled, it will get filled, and I will have that in my position. But sometimes
Hmm.
the market will be like 160 bid at $3, and if I put a
Hmm.
290 offer in, all of a sudden people come in matching me. Oh, now all of a sudden there's 300 contracts with me at 290. So I
And
offer
that's where you know the real offers are. Yeah.
so I offer at 285. All of a sudden there's 500 with me at 285.
Exactly. I do the same thing, especially in the commodities markets, which are okay. The options markets on the blue chips or the indices, they're extremely liquid often, like your Apple, Microsoft, what do you call them? Teeth or something?
The Fang.
Yeah, fangs.
That's
Um,
great.
yeah. Whereas yeah, as you know, I'm more of a commodities guy. I'll deal, in equity indices, but generally always avoid single stock names. I don't think I've had a single stock in my portfolio for, I don't know, a long time anyway. But in commodity options markets, they're a little bit more opaque than the equity options markets, insofar that I think the guys who intervene come in kind of bigly from time to time and don't trade the hell out of them constantly. Therefore, the options markets, when you look at just the chain, even in the middle of the day, it looks like bloody hell, this thing's not liquid at all. What? You put a little one lot in there, even, just beyond the bid, for example, you're going to be matched. You're going to like, wow, 200 contracts, 200 guys wanted to match me. How is that? And then you put in an offer a little bit tighter, and then you're matched there. And so I've done this previously. And what's funny is certain algorithms that work on the commodities options, if I put a one lot in there, they'll match me. Then I'll take it off. They'll stay there. Okay. And then I'll cancel my order, go to the other side, and see how far I can bring them in. And then I can actually, I've done this, is actually I can tighten the bid ask spread on the options markets in commodity. I'm not talking about crude oil, okay? I'm talking about like wheat and corn and sugar and cocoa. I can actually tighten the bid ask spread myself single-handedly with a single lot.
Yeah, well, I don't want to admit to anything that might be in a gray area myself, but let me just say a good friend of mine has been known to come in if they wanted to buy, if they were short some UVXY calls. He's been known to come in, better the offer on a one lot, and then have all the exchanges match him, better the offer again, and keep bettering the offer until the exchanges won't match him, and
And
then
then take
turn
it
around
on
and
the
buy
other
it.
side.
Turn around and buy
Yeah.
it. And that's called, in a sense, I believe it's legal if your order is real enough that that it can
You're
be
willing to take
executed.
the
Right. I'm
okay
willing to
as
sell
a
the one
as
lot.
yeah as a financial markets lawyer. Okay, now this is, each jurisdiction is different,
Right.
each exchange has its own rules, but generally speaking, if you're actually willing to have your order filled, there's no issue there.
Right. If it's exposed to actually being filled,
Yeah.
spoofing it. There's something called spoofing, and
Yeah, I
it,
know.
it
Yeah.
was done all the time uh, when I was trading, and a lot of times it was done like this. Uh, you're trying to sell 500 shares of stock on a thinly listed Nasdaq stock, right?
Uh-huh.
So you're trying to sell it at $5. So you're gonna put a 470 bid in for like 10,000 shares, which is a little bit off the market. So the
Yeah.
market's 495. You're gonna put
Uh-huh.
470 bid in for 10,000 shares,
Yeah.
475 bid in for 20,000 shares. And a lot of times the market's going to get spooked because it's going to see bids pop up and they're going to move up to where your offer is and fill you. And
Yeah.
that's called spoofing, and I believe it's illegal in a way because you don't really want to be buying it. You're just trying to move it.
Yeah. Yeah, I'm again, as a financial markets lawyer and as a former compliance officer in investment banks and trading floors. Yeah, spoofing is has been illegal in Europe and North America for several years now. But it's relatively new. Back in the 80s, there was no rule against spoofing.
But I
You
think
know?
the takeaway for this for retail people should be that don't think that you need to pay the offer or hit the bid to get filled on these wide issues. Most of the time, opening options in these wide issues, they're going to fill you in the middle because they want you to start playing in that product.
Yeah.
You might be, if you're doing one of these really thin traded things like a drip, for example, realize that there's not a lot of liquidity there. Generally, like trading books will tell you if you're beginning, don't be trading stuff that has no liquidity because you're going to get
Yeah.
stuck. And that's a good
And
rule of
that's
thumb.
true.
Yeah.
And I think that's absolutely true, especially if, when you're trading, here's an interesting thing about trading volatility, okay? If you're just, if you're not a vol trader, if you're just, say, a long only long only equity guy, whether you're retail or whether you're a fund, a vanilla fund manager, when you start getting spooked by the market and you want to buy protection for your portfolio by buying puts, for example, you don't really give a shit about the implied volatility. You know, they don't really care.
It's a
They
dollar.
don't.
Well, it's either dollar value or it's just they need the units, right?
Yeah, yeah. I mean, if you got a portfolio and you're going in to hedge your portfolio against an eventual drop or a drop that's happening that you see in the market, you're just going to go and buy it because a put is going to be, even with elevated implied volatility, it's going to be a relatively small price to pay for the protection that you want, and you can, save your portfolio and sleep at night, right?
Yeah. What
So
is a
the
good night's
natural,
sleep? What is a good night's sleep worth to you? You know.
yeah. Well, as I say, sleep is for lazy commie bums, right?
All right. There's that too.
um, but as volatility traders, we we make a difference between, implied volatility at 15 or 20. That's a big deal, you know.
You got to look at the
We
dollar amounts, though, like you said. Yeah.
Yeah, but like compared, if the guy who's a bona fide hedger in the puts, for example, he wants to protect his S&P portfolio, he doesn't care if he's paying volatility at 8 or 12%. If he's getting nervous, he's going to buy it. He's going to buy that option regardless whether it costs him $1.98 or 2.10. It's no big difference for him, you know?
And the reality is that over time, a something option that was trading a dollar represents 180 vol one day, but as time goes by, it's going to represent a different vol. And so
Yeah,
you probably look at it as a are you willing to pay 2% insurance for for something? And you could look at it as a percent of the asset, I suppose.
yeah, exactly. Whereas volatility traders, we make a big deal about a few vol points. For example, on my so I initiated the nice crude oil, NYMEX crude oil short volatility position the other day, and I initiated it when implied volatility was at 26. All right. Now, front month at the money, implied volatility there is at 24.4. That's only a 2 point vol move, okay? And I'm making money on it. Not a lot yet. I just put it on a few days ago, but
But you're collecting your daily theta on top of any Vega move, right?
yeah. So, but just to highlight, as a volatility trader, even a measly 2 points in volatility makes a little bit of a difference to me. Whereas a guy who's naturally going and hedging positions, he doesn't give a crap about two vol points. He probably doesn't even know what implied vol is, and he doesn't care, and it doesn't matter.
Well, as a market maker, when you're trading options against each other in the same month, uh, each time you buy, you have trading sheets that tell you what stuff's worth. Each time you're
Mhm.
buying a lower volatility and selling a higher one in the same month, in the same series, you're locking in a little bit of percent edge into your position. And
Absolutely,
so each
and
time
that's
you're
why
locking in these little bits of edge, and
it
that
adds
turns
up.
in, yeah, it turns into money and it turns into probability in your favor. And
Absolutely.
what we had there, which we don't really have in TOS, is uh, we had an edge calculation, and so it would tell you what you would do is you'd add your P&L from the sheets to an edge calculation each day to give you your total value of your portfolio. So that this would account for stuff being marked weird or edge that hadn't come in yet. So we would add the theoretical value of your positions versus the actual P&L to give you an actual number to tell you how much you've made or lost in the long run.
Yeah.
And that
Huh.
theoretical number would move. If you changed the volatilities on your sheets, it would change that theoretical number. But in a sense, it would tell you how much edge you'd locked in. Because if you have wide markets and options and you're selling on the bid, buying the offer, like you're buying the 13th strike, now you're selling the 15th strike, now you're buying a put here, now you're selling a call over here. And each one is around, a value. Like if you have one that's worth $3 and you're buying it for 250 and you're selling it for 310, each time you're buying stuff for better than your sheets and selling higher than your sheets, you're locking a little bit of edge, and
Yeah.
that is where you make the money as a market maker.
Yeah, that's fascinating that you say that because I was just discussing this a couple of days ago with somebody, and I said, you could do a really dumbass approach on the options market and probably make a bit of money, and it would be simply looking at the vol skew, and you sell options for an equivalent dollar value at the highest implied volatilities on the skew, which are going to be way out of the money generally speaking, and you buy at the lowest equivalent dollar amount at the bottom of the skew, do nothing, wait until expiry, repeat the process a million times, you'll probably make money.
Yeah, that's real. That's real probability. That's real statistical advantage right there. Is what
Exactly.
mathematically it comes down to the odds in your favor.
Yeah.
And
I mean,
it's built in for a reason, but
yeah,
that's real. That's real edge right there, and that's real money.
yeah,
And
yeah.
conversely, when you're trading stuff that's disadvantageous on the skew, you're giving up real money for that protection or
Hmm.
whatever. And it's even though it shows on the screen, okay, well here's the market on this and here's on this. If you're buying the higher vol one and selling the cheaper one, you're giving up real edge, and you're going to have to make it up some way. Either you're directionally right or you've got data in your favor or
Or be
something.
nimble or whatever. Yeah, but yeah,
But that's
and
real
that's
money.
why
Yeah.
the second part of my process when putting on a volatility trade. Okay, first locate the high volatility for the optimal asset to trade. Step two, look at the skew because that skew is where you get your edge. Well, first of all, the entire vol surface and then the skew, yeah. So,
Yeah, I mean, obviously, picking the right options to trade is hugely important. And there's a number of factors. It's not an easy thing to learn which options to pick. That's something that takes a little bit of time because you need to evaluate not just volatility, but the actual dollar value of what you're dealing with.
well,
And
that hence my this ratio that I use to come up with the relationship between implied volatility and the deltas.
and that's a skill that you really have to develop over a little bit of time. Options
Yeah, I
picking.
mean,
It's
now I
not.
can just look at it.
Yeah.
I can, like, when you're really familiar with that, I can just look at an option chain and I can right away imagine the skew, you know? I could draw a skew just by looking at an option chain for a few seconds, was because I just repeat the process. I'm looking at option chains day in, day out, and you get a feel for it. But it's not all that complicated. It sounds complicated, but it's actually not when you concentrate on it a little bit and learn it, and then it's a massive advantage over time. Massive.
Yeah, I mean, for me, the learning curve was having 40, 50, 60 positions on and going through so many expiration cycles and having, if you have 50 positions on, every conceivable thing that could happen is going to happen to you over time, multiple times. And so you learn to things like getting your short units in. Once you get towards expiration, it's a couple days towards expiration, you want to cover those short units. Sometimes it's not worth it to wait, get that last couple cents squeezed out of it because once an option gets to like 5 cents, it's not going to decay that much. It might get to 5 cents a week before. You might as well just
Hmm.
get those units off your sheets.
Yeah.
A lot of people, that was the big thing for me with the UVXY huge move was to be unit neutral in the end. A lot of people
Hmm.
are not are refusing to have any short exposure as far as naked options in these volatility products now because they've gotten burned so badly.
Hmm.
I don't necessarily believe that you should no longer sell calls because you got burned once, but at the same time, be smart with units. You don't when you're selling a call or a put to somebody, you're giving them the right to buy 100 shares of that underlying or whatever the conversion is. You don't want to give
Hmm.
away that right to someone for peanuts. You want to make them pay. You
No.
want to make them pay for that right. Why give it away for
Okay, and that's
peanuts?
precisely, you just hit it on the head. That's precisely why there's a floor in implied volatility. Okay, is because here, again, I'll just refer to what I wrote. um, Not to give it all away, but that's an interesting concept. Let me see. If you have a couple more minutes, if you bear with me.
Yeah, well, you're good luck for my markets right now. So
Yeah, I all my positions are doing phenomenally well today. Not to brag, but it's nice. Short volatility, observation, short volatility. Let me just find it. First volatility.
yeah, it's been an amazing market recovery in the ES, and
Yeah.
it looked scary there for a second.
You know what? If I wouldn't be scared anymore from time to time, I'd probably quit.
Yeah, yeah, of course.
You know, because I'm not in here for the thrill and excitement, but
It keeps you
if I
engaged a
were,
little bit.
well, it makes life a little bit entertaining. First of all, to get really scared shitless. That's kind of fun sometimes, but also if you're not scared, you're probably brain dead.
Well, people, Tom Sosnoff from Tasty Trade makes a point. He makes this point all the time that people now are very risk adverse in the world, and if you're too risk adverse, you're not going to be able to be successful, and
Absolutely
it comes
true.
with
And
business and everything
yeah,
else.
yeah, I have a lot of respect and admiration for Tom. I've spoken with him on several occasions about some interesting things just over the telephone because he's in the US, I'm in France. But yeah, he's a bright guy. I appreciate him, and he has a lot of very bright things to say. Yeah?
Yeah, the other thing that's really bright, I think, is he's always willing to make side deals with his business to move things forward. He's not worried about giving up a little bit of the the equity or whatever to make side deals with people to get stuff done. He's very flexible
Hmm.
business wise, and I
Yeah,
love
here. Can I read a paragraph to you that I wrote
sure.
concerning you were saying that the vol sellers, they need something in it, right? So let's start with one fact. Implied volatility is often overstated compared to realized volatility, right?
Right.
That means if implied, say take an option that is 12 months out and it has an implied volatility of, we'll call it 10, okay? That implies that the underlying is going to move 10% that year, up or down, right? Now, what's going to happen statistically more often than not is the underlying will move maybe 7 or 8% and not 10. And this implied volatility is, it's 80% of the time it is overstated. Why is that? And I want give me your take on it.
Well, we've talked about
Hold on, let me read something to
sure.
you.
Okay.
Okay, so I asked, why is volatility mostly overstated? Are options buyers just naive? Are options writers particularly savvy? In reality, both the option buyer and the writer should reasonably agree to negotiating a price carrying an implied vol, which is in fact greater than their realistic expectations of future underlying market movement. So, why should the option buyer reasonably agree to paying higher implied vol than his actual expectations of future market movement? First, and we covered this briefly, from the buyer's perspective, the paltry price of an option compared to the value of the underlying which the option is insuring may appear to be but a small fee for insurance and peace of mind. Whether the option buyer pays 230 or 248 for an option may be of little of consequence to him. Second, from the option writer's perspective, this party to the trade is in the business of insuring against adverse price risk. As a risk taker, the option writer will necessarily and reasonably require a premium over the real perceived risk. This is entirely rational. After all, why should anybody be expected to contract to indefinite liability without receiving some degree of compensation? And
Totally.
I think that's the idea that we're talking about here, right?
Yeah, I mean, you can't stay in business if you're operating at a loss. I mean,
Yeah, yeah. If the volatility, implied volatility goes down to that, what I call floor, nobody's going to be in the business of selling volatility anymore. This is just not worth it.
and also people's fear. I mean, people talk about psychology of fear of being. People are more
Oh,
afraid to
blimey.
gamble.
Implied volatility on Eurostox 50, it's probably the same in the US now, is dropping like a stone. And I'm having a hell of a good Friday.
Yeah, VIX is down a point, and the VVIX is down almost $5. The earliest VXXT is down at buck 36. So we're seeing vol contraction everywhere, and it makes sense because this is the third day in a row that indices are up,
Yeah,
and
yeah.
people are
And
worrying about their weekend. These guys. That's one thing about decay. When you buy an option, you have to pay for the decay for Saturday and Sunday, even though the market is, by definition, not moving then.
yeah, and yeah, that's right. And
So
we
fund
covered
managers
this.
start thinking on Friday, like, oh, I'm long all this protection. I can make another couple bucks. It basically, volatility is going to come in because people's greed gets higher than their fear. And
Yeah,
it's true.
yeah, yeah. So how is it, Dave? Are there any other topics that you'd like to discuss for the interview here?
I think we've covered a lot today. I don't want to
Me
put I
too.
don't want to
It
put
was
too
fun
much in
though.
people's house.
I love speaking to you, man. You're great.
Well, it's always a pleasure, and I know people really enjoy watching you, and
Well, I think
it's always fun.
they enjoy watching you more.
I don't know. I like bringing on different people. I've had some great people this week. I had one guy who has a trading system that he
Hmm.
basically looks at ratios between in back month volatility to see
Yeah.
when there be a spike, and he was able to avoid the last spike, which is awesome.
Huh.
But yeah, I always like to talk to you, and it's fun to have you on. So that's awesome. And I think
Yeah.
people will get something out of this because yeah, you have a unique a view of things as a manager, and
How so would you say?
well, just because not that many people trade the products that you trade. I know people are very interested in the e-stocks. And in, I mean, you trade a ton of products, you know, whether it be
I just go to
UK.
where the opportunity exists, you know? I'll trade Asian, European, American, Canadian, Australian. I don't care. If there's opportunity, I'll go jump on it,
Well, that's
you know?
something to aspire to for a lot of us.
Yeah.
And you also it gives you a broader understanding of where what volatility is doing. As you said, though, it seems like it's becoming more uniform across the board now.
Yeah, but then, you gotta seek that diversification, even if the correlation is tighter these days between asset classes and jurisdictions, you still have to seek it. It's never going to be perfectly matched. Oil will always move a bit differently than the S&P 500, and the European indices will always move a bit different than the Asians and so on. You have to seek that diversification, because even a little bit of diversification in your portfolio can help you, as the poor guys who got blown up on Ziv the other day know all far too well now.
Well, I mean, you've definitely been a force to help a lot of people on Stocktwits. I see you there all the time helping people out, and that's a really cool thing of you to do. I know a lot of fund managers who have just sort of thrown up their hands at dealing with people on social media, and
Mm.
you're one of the good guys who's actually, you know, stuck with it and taught some new people about trading. It used to be like a secret, you know, like oh, we can't tell anybody what we're doing. Oh, you know, we don't want to educate
Mm.
anybody, but it's changed a lot now in the retail world.
Actually, by telling people what I'm doing, that's how I learned, you know? Because I've been criticized and constructively and said, no, Justin, you're doing that wrong. You should be thinking about that. Don't worry about that, and explain why. And it's helped me improve. And
Same
I
with
just,
me. Same with me. It's like now what we're doing has to stand up to other people's checking it out. So you're not, you know,
yeah.
it keeps you from getting sloppy in a way.
Yeah,
From
if I were to keep everything secret, I wouldn't be learning because nobody would be constructively criticizing what I do, and then in turn, I'd not be, learning and implementing better ideas.
And I think we found that from a lot of people in our little Stocktwits group who a lot of people have had learned independently of anyone else how to trade and have been sort of in such a vacuum in a bubble that nobody was critiquing what they were doing, and I think they've gained some insight from this even if they were successful traders before.
Hmm. Yeah, yeah, I agree, and thanks to guys like you who are even further consolidating this knowledge, and you're out there seeking the guys who have some pretty sharp ideas, bringing them together, picking their brains, and then throwing it out in public, and it's highly entertaining. It's professionally of value, and we all appreciate you a hell of a lot, Dave.
Oh well, thank you very much. I enjoy it. It's great to have people that follow because I tell you, people wouldn't pick up the phone if I hadn't, if it wasn't for guys like you that gave me a chance at the beginning. And now people know that there's other people in the industry watching, and so it's not me they're picking up the phone for. It's for you. It's for everybody else that's watching, and so it's become a little bit easier to get access now, which is a joy for
Yeah,
me.
and I like this community that we can create and maintain via the internet and everything. Where you live in Which state are you in?
I live in Massachusetts on Cape Cod.
Yeah.
Yeah. But it doesn't even
Okay.
matter because of the internet. Like I don't know where a lot of the people we talk to live.
I know. I live in the south of France. You're in Massachusetts, and a number of our buddies out there are all over the camp. And yeah, we speak regularly. It's a hell of a good time, and I'm really appreciate that guys like you help consolidate these good people. Hmm?
Well, it's been fun, and we'll hopefully it'll be profitable moving forward for us all.
You're gonna make a so you think you have some good editable material here?
Yeah, well, what I did was I recorded the whole thing as a stream, and then but I probably will just pretty much leave it the way it is because
Okay.
I think it's interesting the whole way through with your permission
Oh yeah, yeah, absolutely, Dave.
and
No
just let
problem.
people look at it because I like the idea of sort of a longer form interview that people can dig into, and there are
Mhm.
actually are people that are very interested in this stuff and that want to check
Yeah.
it out. And if they're not, then there's 1,000 other YouTube videos they can watch out there.
Yeah, exactly. So what are you doing this weekend? Anything fun?
Well, it's kids' vacation week in the United States, so I'm going to be working. I have a side job at a resort, so I'm going to be at the resort all weekend working. And then I have got a couple interviews on Sunday night, and we got some
Right.
new people coming on board. This YouTube stuff takes up a lot of time, the editing and
But you
everything.
enjoy it, I see.
Yeah, it's fun. It's fun,
Yeah.
but it definitely takes up a lot of time, and it's become a scheduling thing now. So I'm.
Well, I'm sure when you're starting, it's a bit difficult, but I'm sure you'll control the time uh, as you'd go on, you know.
Well, it's very stimulating to be working in something that I think has value, and
Hmm.
I mean I like hard work, and
I'll tell you one thing that the red velvet is very stimulating too. We love it. It's really cool.
I found that somewhere. You like that?
I love it. It's
Awesome,
it's it's all you, man.
awesome. Well, thanks a lot, and I will see you back in the
You know
Stocktwits
what?
room
I already
again.
have I'm 6 hours ahead of you in France on a Friday evening.
Okay.
So European markets are closing in 6 minutes, and my Valentina, she's already starting a party
Oh
in
wow.
the lounge over there. So I should go join the guys for a drink.
All right. Nice. What are you up to for the weekend?
This weekend, just doing some legal work and relaxing. Probably hang out in the terrace of the cafes. It's already nice weather out here. I was just out in a jumper today. It's fine.
When's the next trip to Mauritius?
Well, I have no need to go there physically, you know?
Yeah. Yeah.
Yeah. Mm.
Cool.
And I don't know. I don't know if I used to travel so much. I'm kind of sick of it. And then we're so spoiled down in the south of France here. I have little need to travel, little desire to travel as well. Except if, of course, if I get a good invitation somewhere. Hint, hint.
Yeah. Well, I'm headed to England in a month, so I'm excited about that. I wish I could come join you in the Midi, but I'm only there for a week. So,
Ah,
but
okay. Well, another time you'd be welcome to come here with pleasure. That'd be a hell of a good time.
thanks so much. All right, great. Well, thanks so much for the interview, and we'll try to put it up quick. And I will see you trading. Go join the party.
Okay, man. Thanks a lot. Have a
Okay.
great weekend, David.
You too.
Bye.